Today, ambiguity rules. The DFA daily to the 19th of August 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's post, we look at the latest from the Fed and why it drove markets lower, Robinhood's results, and the latest on UK inflation and why the Bank of England is still forecasting rises of twice its target. And then we come back to Australia and look at weak mortgage lending from ANZ and the fallout from the BHP betting on potash over big oil. But first, US stock benchmarks finish lower for a second day on Wednesday, with losses accelerating after the Federal Reserve July policy meeting minutes showed plans to reduce the central bank's monetary support later this year. The S&P 500 fell over 1% after the release of the minutes from the Federal Reserve's policy meeting last month, because officials indicated that they felt the employment benchmark for decreasing support for the economy could be reached this year. Stocks accelerated the declines late in the session, pushing the S&P 500 down about 1.8% from its record closing high after its second straight daily drop. It was the benchmark index single-day first drop of at least 1% since July 19th. Most of the S&P 500 sectors ended lower, with energy falling 2.4% and healthcare off 1.5%. The minutes of the July meeting showed different groups worried about inflation and the need to prepare to combat it, with others saying it would take time and require patience from the Fed to put Americans back to work. Most participants noted that provided that the economy were to evolve broadly as they anticipated, they judged that it could be appropriate to start reducing the pace of asset purchases this year, the Fed's minutes showed. The labour market is the heart of the Fed's decision on when to get tapering underway, but the central bank believes there is still ground to cover on jobs. Most participants judged that the committee's standard of substantial further progress toward the maximum employment goal had not yet been met, according to the Fed minutes. Most participants remarked that this standard had been achieved with respect to the price stability goal. With the Federal Reserve now largely expected to begin scaling back its bond purchases by the end of the year, investors believe the central bank will need to take a proactive approach, taking its foot off the tightening pedal on any sign of worry in the economy to keep stocks grinding higher. Investors are looking for signs about when the central bank will rein in its easy money policies, including tapering its bond buying program, which has been crucial support as the S&P 500 has roughly doubled from its March 2020 low. The Fed minutes did nothing to dispel the thought that tapering will begin soon, said Peter Tutz, president of Chase Investment Council in Charlottesville. We are closer to the end than the middle of tapering, and people don't know how to react to it. The Fed will begin to increasingly reduce its monetary policy support at a time when many see this summer as peak stimulus, Ziwi Ren, managing director and portfolio manager at Penn Mutual Asset Management, said in an interview. This could be an issue for the economy and for the market. One way the Fed can avoid this is to change course right now if they see something wrong, Ren said. This is what the market is currently pricing in now. The market doesn't think the Fed will get to 2.5% neutral rates, but rather 1.5% or 1.6% and then stop tightening. The Dow Jones Industrial Average fell 1.08% to 34,960. The S&P 500 lost 1% to 4,400, and the Nasdaq dropped 0.89% to 14,525. With the market in a period that has seasonally been weak historically, investors have said stocks may be due for a significant drop, with the S&P 500 yet to experience a 5% pullback this year. but focus now shifts to the Fed's annual research conference at Jackson Hole, Wyoming next week for any read about the central bank's next steps. Many analysts expect the Fed to announce its plans to taper asset purchases as early as the September 21-22 policy meeting. Fed tapering is clearly in training camp mode, with Jackson Hole likely being a pre-season game, and either the September or most likely the November FOMC meeting being the time to announce how they will pull back stimulus, wrote Edward Moyer, senior market analyst at Onda. It's clear from the minutes that the Fed isn't ready to start tapering yet, but they are leaning towards making an announcement by the end of the year at the latest, said Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. While the Fed minutes reveal more conviction in terms of starting to taper this year, they made the bold point that there's no connection between tapering and rate hikes, wrote Mike Longrat, Managing Director of Investment Strategy at E-Trade Financial. A rebound in the US economy, including a stellar second quarter corporate earnings season, along with accommodative monetary policy, has underpinned positive sentiment for equities. We have gotten a rash of both earnings and economic data over the last few days that broadly is pointing to a positive outlook for the fundamental backdrop to the market, said Craig Fair, investment strategist at Edward Jones. The one wild card at this stage is going to be the role Fed stimulus is going to play. Well, I would add also, of course, the role of the Delta variant. Monetary policy aside, a slew of retailers, including Lowe's and Target, reported quarterly results that topped Wall Street expectations, but saw mixed reactions from investors. Lowe's companies jumped 10% as the home improvement retailer lifted its full-year outlook after reporting quarter results that topped analyst expectations. Target Corporation, meanwhile, also delivered quarterly results that beat on the top and the bottom lines, but its share fell 3%. Krispy Kreme, which made its return to the stock market last month, fell 7% after the donut chain reported mixed quarterly results as earnings fell short but revenue beat expectations. Energy stocks, meanwhile, shrugged off intraday losses despite weaker oil prices amid data that showed a larger than expected decline in weekly US crude inventories, but an unexpected build in gasoline inventories. Crude inventories dropped by 3.2 million barrels last week, compared with analyst expectation of a draw of 1.1 million barrels, according to data from the Energy Information Administration. In big tech, Amazon was in the spotlight after the e-commerce giant reportedly warned certain third-party sellers that antitrust laws approved in June could limit their ability to sell on Amazon. Apple, Facebook, the Google parent Alphabet, and Microsoft all closed below the flat line. On the vaccine front, the US government said it plans to make COVID-19 vaccine booster shots widely available starting on September the 20th, amid concerns over the rising COVID-19 infections. Moderna, Pfizer, and BioNTech were all in the red, though. The boosters would be for those who received the Pfizer or Moderna shots, but not yet for those who received the Johnson & Johnson one-dose vaccine. And earlier on Wednesday, St. Louis Fed President James Bullard said he would like to see the tapering of the asset purchase program done by the first quarter of 2022. Several other officials, including Robert Kaplan of Dallas and Esther George of Kansas City, have urged the central bank to begin removing stimulus as soon as the September meeting. Chairman Powell and Vice Chairman Richard Clarida have suggested they would like to see further progress before considering a move to taper. And in late trading, Robinhood Markets, the pioneer of commission-free trading apps, sank after reporting its first results since going public. It benefited from strong interest in cryptocurrencies in its first earnings report as a public company, though the company continued to warn that the September quarter was unlikely to match the June quarter's record levels of activity. The company posted a second quarter net loss of $502 million, or $2.16 a share, whereas it recorded a profit of $58 million, or 9% a share, in the year earlier quarter. Robinhood was up 6.71% and noted in its earnings release that it saw $528 million in costs associated with the fair value of convertible notes and warrant liabilities in the period. Shares fell more than 3% in after-hours trading after closing their regular session at 49.80. Robinhood had detailed in a July filing with the Securities and Exchange Commission that it expects the loss of about $487 million to $537 million for the quarter. Revenue for the June quarter rose to $565 million from $244 million, and revenue from cryptocurrency transactions accounted for $233 million, up from just $5 million in the prior June quarter. The company had said to expect $546 million to $574 million in total revenue for the period in that SEC filing. The company had 22.5 million net cumulative funded accounts in the June quarter, and it had 21.3 million monthly active users, and Robinhood had $102 billion in assets under custody, up from $33.4 billion a year prior. We're encouraged by the number of people who are accessing the financial system for the first time through Robinhood, Chief Executive Vad Tanev said in the earnings release. The company reiterated a warning from the filing, noting that it expects revenue for the September quarter to be lower than it's seen in the June quarter. The company expects seasonal headwinds and lower trading activity across the industry to result in lower revenues and considerably fewer new funded accounts than in the prior quarter, it said in its release. European stocks edged lower on Wednesday overall, with concerns of a COVID-induced global economic slowdown weighing on markets. The FTSE was down 0.16% to 7,169, although the DAX rose 0.28% to 15,965. Also of interest was the UK consumer prices, which rose 2% year over year, sharply slowing from the 2.5% growth seen during the previous month and lessening the pressure on the Bank of England to tighten monetary policy. That said, this dip is likely to be temporary, especially given the sharp rises in household energy bills this year. So many see this as just a blip on a way to double the Bank of England's target this year. It's the first time in 4 months that inflation rose less than the economists had expected. The slowdown partly reflects a sharp rise in prices in July last year, when some of the restrictions deployed during the first coronavirus lockdown were eased, and with the economy mostly reopening except for overseas travel, inflation is expected to accelerate quickly, driven largely by the cost of energy and shortage of both goods and labour. The Bank of England plans to reduce its stimulus to ease pressure on prices. Clothing and footwear prices fell during the summer sales season, which, along with a variety of recreational goods and services, made the largest downward contribution to prices. Fuel prices reached the highest since September 2013, and that was partially offset by an increase in the cost of used cars, which fell a year ago. About 0.2 points of the easing in inflation were due to the base effects from last year. But the Bank of England predicts price growth of 3% in August and more than 4% in the final 2 months of the year. And economists are a bit less pessimistic, seeing a peak of around 3.6% in the first quarter of next year. The pickup is set to be driven by global increases in energy and goods prices, mirroring the US, where annual inflation is running at around 5%. And crucially, the Bank of England policymakers say the surge is likely to be short-lived, though they warn that the strength of economic recoveries mean some withdrawal of monetary stimulus will be needed to return inflation to target over the next 2 years. And here in Oz, ANZ, who posted its quarter update on Wednesday, revealed it had seen a $300 million decrease in its mortgage balance sheet during the 3 months to the 30th of June. The total housing loan portfolio sat at around $280 billion. A $16.2 billion rise in mortgage lending during the quarter had been offset by $16.5 billion in paydowns. In previous quarters, the bank had recorded markedly smaller paydown rates, with averages around $15 billion in the December quarter, $14 billion in the second half of 2020, and $13 billion in the first half of 2020. NZ said that there had been an ongoing shift to principal and interest loans, as well as customers accelerating their principal reduction by increasing their offset balances and paying more than their minimum repayments. And the bank also stated that it had actions underway to address a rise in refinancing out and to improve turnaround times, with counterattacks including adding assessment resources, process simplification and automation. Looking at deferred support amid the ongoing lockdowns, around 80% of both housing and business loan deferrals have been provided in New South Wales. In mortgages, deferrals have been provided at around 1,300 loans or $600 million worth at the moment. The level of deferrals were equivalent to around 1% of the total provided in the prior 2021 period. In business lending, deferrals have been provided around 50 loans or around $70 million, and the total business loan portfolio was around $70 billion. Current deferrals are well below the approximate 24,000 business loans deferred in the prior 2021 period. And the day before, Westpac also released its third quarter trading update, revealing a drop in mortgage delinquencies. The Big Four bank signalled that it was considering a return of capital to shareholders, with an update expected in its full year results. Westpac may follow the Big Four rivals of ANZ and CBA in launching a share buyback, partly of course thanks to very cheap money from the RBA via the Term Funding Facility. ANZ reported its $1.5 billion buyback, which commenced on the 4th of August, and is expected to reduce its common Tier 1 equity capital by around 35 basis points. And recent Roy Morgan analysis estimated that NAB's $1.2 billion acquisition of Citi's local consumer business will grow its customer base beyond that of ANZ, with both banks currently serving around 9 million customers. Metal giant BHP Group slumped on Wednesday after the prior day's big rally, as investors questioned the group's major shift in strategy that will see it merge its oil and gas unit while investing billions more in potash. Up 3% on Tuesday, BHP shed 5% to trade lower than where it stood before its first announced talks to combine its oil assets with those of Woodside Petroleum. Petroleum houses a large share of BHP's near-medium-term growth projects. An exit from this business increases the likelihood of copper and nickel acquisitions, in our view, said analysts at Deutsche Bank. An analyst at JP Morgan added that cost guidance announced on Tuesday will have it cut its earnings forecast by 5% for fiscal 2022. The proposal to combine its dual listing structure should help the London-listed BHP Group shares close a 21% discount to the Sydney-listed shares, they added. Outside of BHP, other major metal companies also struggled in the UK, with Anglo American down 2.21%, Rio Tinto down 2.57%, and Glencore down 1.9%. So the BHP and Woodside strategy is interesting insofar that they've created a separate good company, bad company with regard to its oil assets. And it'll be very interesting to see whether investors actually buy this strategy or whether they see value diminution coming off the back of it. So standing back, wherever you look, you can see considerable ambiguity in the marketplace at the moment. The markets are down a bit and are a bit more worried about the Delta variant, but more directly concerned that the Fed will truly start to taper. And if they do, of course, that is when the markets will definitely turn sour. And as I've said on several occasions before, and I'll say again, September and October is the time of year when, if there's going to be a correction, it's most likely to occur. So, in a time of ambiguity, be extra careful. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.